Hey everyone, this is Ryan Mallory for SharePlanner.com. Today is December 3rd, 2014. Doing another Google Hangout with you all. And let's go ahead and just jump right into the stocks here. First, we'll begin with the indices, and with no other than the S&P 500. So the price action that we got on Friday, the day after Thanksgiving, usually you don't see a lot of big movements in the stock market following Thanksgiving, but we had one, I think it was like 2009, where the market sold off triple digits on the Dow and pretty significantly, double digits on the S&P 500. But we hadn't really seen anything like that since then. But on Friday, the day after Thanksgiving, markets opened up a half a day, and you had a pretty good size red candle. In fact, the biggest candle, you could say, since October 22nd. So pretty much like the worst sell-off, and happened on a half day when most people are not even paying attention to the markets, and it happened the day after Thanksgiving. So that was a little bit of a cause concern. So what I'm going to do here is I'm going to show you the S&P 500. I'm going to go back and forth between the S&P 500 and another indicator that Warden offers called the T2108, which you can also get free on their website. I think it's like freestockcharts.com. You can get the T2108 there. And what the T2108 is, the percentage of stocks moving or that they're trading above the 40-day moving average. So like right now, it's 62.68 is what it's reading out. They actually give this to you real time with Warden, which is really cool, because it used to be before they would give you an end of day reading on the T2108. Not so anymore. It's real time, just like anything else out there. But what it does though is it measures all these stocks, and so you can oftentimes see a weakening in the indices before in stocks before the indices actually start showing it. So on that Friday where the market had its sell-off, I mean, you could see there was it had a good move there. It went from almost 70% of stocks trading above the 40-day moving average to to around like 63.5. So that was a good chunk of stocks that saw significant moves and below their 40-day moving average. And then the following day, and this is what kind of got me on my heels a bit, was the next day sell-off that took us below this current range from the previous gap up and everything else. So if you look at the SPY, you can see we were way below that gap. But so far it looks like that move that we got on Monday was nothing more than really just filling that gap. And the markets do like to fill gaps. That's one thing we all know. And apparently, based on what we've seen on Tuesday and then again today, that's all the market was trying to do, because December is a pretty bullish month. 2008, I think you have to go back to 2007, where we didn't finish higher in the month of December. But even in 2008, we finished higher. And if you guys remember 2008, that was the year of the big sell-off, the Great Recession, whatever you want to call it. But nonetheless, the market finished up in December in 2008, and it's done so each year after that. So here we are in 2014. I expect that we'll probably see the market finish higher in the month, but that day after Thanksgiving, the last day of trading in November, and then again on Monday, first day of trading in December, it just didn't behave like it should. Now, historically, the first month of December usually isn't the best trading day of the Santa rally. Okay, the first day of the first week of December, it tends to be slightly bearish, and then from there on out, it recovers quite nicely. And we're seeing that a little bit here, okay, with the Monday sell-off. But now we're basically leaving it in the dust and pushing higher here. And it's not going to be too long here before we're challenging new all-time highs yet again. Now, what's on everybody's mind is, how long can this go, man? I feel like the rug's going to be pulled out from underneath us, and we're going to lose all this money. And I think you got to have a healthy paranoia of the market. If you just fully trust yourself to it, then that's where you get yourself into trouble. But you also have to let the charts do the talking here. When you start getting too paranoid, then you start trying to front run a big sell-off. You start shorting a market that's clearly going up, and you don't want to do that. We took some insurance on Monday with SDS, and we took some insurance on Tuesday with Warden. And we took some insurance on Wednesday with Warden. And we took some insurance on Thursday with SDS. And we took some insurance on Friday with SDS. And we took some insurance on Saturday with SDS. And we took some insurance on Sunday with SDS. And we took some insurance on Monday with SDS. And we took some insurance on Tuesday with SDS. And we took some insurance on Wednesday with SDS. And we took some insurance on Thursday with SDS. And we took some insurance on Friday with SDS. And we took some insurance on Saturday with SDS. And we took some insurance on Sunday with SDS. And we took some insurance on Monday with SDS. And we took some insurance on Tuesday with SDS. And we took some insurance on Wednesday with SDS. And we took some insurance on Thursday with SDS. And we took some insurance on Friday with SDS. And we took some insurance on Saturday with SDS. And we took some insurance on Monday with SDS. And we took some insurance on Tuesday with SDS. And we took some insurance on Wednesday with SDS. And we took some insurance on Thursday with SDS. And it's a tight stop. We're down like 1.7% in it right now, and actually very close to going ahead and closing it out at 21.93 if it hits that mark. But why did we do it? Well, because the T2108 was showing some erosion under the surface with stocks. Now, that's clearly not been the case over the last 2 days. But when you have a big movement like that, where you're dropping below key support on this indicator at 60, that's why I basically added a little bit of a hedge to it. It's not a hedge that's going to hurt us at all. It's very easy to recover from, but it was worth taking that insurance out to give us a starter position in case the market was going to go south on us. Now, hedging yourself against a move south and trying to front run the market is two different things. When you're front running, you're trying to get net short, and you're trying to get, you're trying to get ahead of the market before it actually sells off, and you're wanting to add all these short positions because you have this strong belief that the market's going to sell off. My reason for getting into SDS wasn't because I necessarily thought the market was going to sell off. I saw that there was a potential for it, and I wanted to make sure that we were hedged appropriately in case that did happen, so that we could manage our portfolio better. Because at that time, I didn't want to be 50% long, and we had some pretty good positions in the portfolio. So I felt like it was necessary to keep some insurance through the use of the ultra short on the market. So, once again, we'll probably end up having to close out of that one if the market moves much higher on the day. But but back to what I'm trying to say though is let the markets do the talking for you. Okay, the T2108, the stocks were clearly eroding, so it said, okay, there's some caution that's warranted here, but but it wasn't enough to say, okay, you need to go sell all your long positions, do a fire sale, and go get short 100%. No, that's not what the market was telling us. It was just telling us, hey, there could be some cracks underneath the surface here. You need to show some caution. So that's what we did. It was worth doing, and I'd do it again every time. So that's the S&P. I won't harp too much more on the S&P. It is, pushing towards new all-time highs again. I think the all-time intraday high is 2075, so we're only like 3 points off of that. All-time closing high is 2072, which we're like a half point below. So there's a good chance we will be at new all-time closing highs today. Let's look at the NASDAQ. And these are the only two indices I'm going to really focus on today. The Russell, it's range bound. That's been the case the entire year. Until that changes, there's, it's been basically irrelevant to the S&P, the stocks in general, and the NASDAQ. So the NASDAQ, similar chart to the S&P 500, didn't have the day that on last Friday that the S&P had. Nonetheless, though, it's pushed up higher. And what's really crazy is when you see if I can do this without messing up my chart. When you look back at the monthlies, I never thought we'd see this day here where the NASDAQ is literally coming close to challenging those 2000 highs, which was 551.32. We're not that far away from it, man. I mean, literally next year we will, if the market still remains bullish, we'll see new all-time highs on the NASDAQ. That's really crazy. I mean, I thought we would be maybe a century before we saw 5,000 again on the NASDAQ. That just shows you what kind of bubble we're in. I mean, good grief. Back in 2009, we were bottoming out at like 1280, and now look how much the NASDAQ has gone up. I mean, it is just shocking. Okay, so anyways, on the daily on the NASDAQ, it's really the same situation. It held the 10-day moving average where the S&P 500 didn't, and it's definitely the healthiest of all the indices. It's still pushing higher. It's very possible we see 4,800 this week on the NAS. Let's go ahead and look at some of the positions in our portfolio. You do have Starbucks here. Why have I not sold Starbucks yet? We're up about 2.25% on it. We could go ahead and take those gains and move on to the next trade. But and I was talking about this earlier in the chat room. For those of you who are in there, I talked about the need to not trade based off of what the dollars say in your portfolio. I call it dollar watching. I think it's a bad thing. It really messes up your trading a lot. It's basically when you're making decisions based on the dollar amount of gains or losses that a position currently holds. And oftentimes when we're looking at the dollars, we tend to personalize the gains and the losses. And so we start making decisions based off of, hey, I just made $600 on a trade. I can, pay the mortgage with that for this month. That's a bad idea. If that's what you're doing, then you're probably either trading with money that you shouldn't be trading with, or you're trading with money that you can't afford to lose. So you should reduce your position sizes. So with Starbucks, yeah, I don't enjoy the last 3 days of selling, but look at the chart here. Has the trade actually broken down yet? And the answer is no, it hasn't. It has not broken. In fact, what we could be seeing here is what we currently are seeing is a pullback to this trend line here off of the October lows. It's pulled back and each time, and it's bounced higher. So we had a 2-day pullback here. Today, this time around, we have a 3-day pullback. Now we want to see if the bulls can jump in and push this back up into the mid 80s. And then you have a trade that was very disciplined. We played along according to the charts. We didn't dollar watch. We didn't worry if there's a couple $100 that it's pulled back or whatever. That's not the point of trading. The market doesn't care about your gains and losses. So you got to care about what the market cares about, and that's the charts. So if the chart's not breaking down, the trade itself is not breaking down, there's no reason to get out of it. We're still holding this trend line here. We're still holding multiple breakout levels. But I will say this, though. I mean, if we break below this trend line, and we're still below it at the close, then I'm going to probably sell the position and move on to the next trade. If it doesn't do that, then we still have a valid trade here, and we need to play it accordingly. SDS, we talked about this one, so I'm not going to spend much time. It's a hedge. If it breaks below 21.93, which it's really close to doing, I'm going to go ahead and sell it. DHI. This one's been a little bit of a frustration here so far. It's not really behaving horribly, but I expected a little bit more out of it, especially this morning. I mean, it was coming out of the bull flag perfectly, and then it has sold off, and it's not recovered much since then. Very close to even stopping out of it. I have a really tight stop loss. I think it's like 1.7% stop loss. So it is a very tight stop loss. The stock can move quite a bit if it takes the notion to doing so. But so far, we're still in the trade. I don't see any reason to hold DHI if it breaks below this the previous lows in this bull flag here. If it does that, then we need to go ahead and just get out of the stock. But right now, it's at 25.21. The trade still remains valid. And we'll go from there. We'll see what it can do throughout the rest of the day. GLW, this was one that we got into today, and it's really done good right out of the gate. I mean, we're up, about 1.7% on this trade. What you have is this huge inverse head and shoulders pattern here. You see that? So you got the left shoulder, and I've already circled it because I provided the members of the splash on this chart, right when we placed the trade. You have the left shoulder, the head, and the right shoulder. And what you can see here is it's broken out. So it did that, about a week ago, and then it's pulled back, held that support, the support here connecting the neckline for the inverse head and shoulders, and now it's popped, and so now it's pushing higher again. And this was why we got long on. We got long at 21.20, which was quite a ways ago, but it's going really good. I'd like to see it get into the 22s and thereafter. But, take it a day at a time. But the chart looks fantastic. Now, let's look at some other trades that I'm looking at here, because there are some other ones that are really good that are out there. First off, AA got another bull flag here. Some of these bull flags have not been playing out as well as I would have liked to have been this past week. But nonetheless, you have that here. One of the things with the AA that concerns me a little bit is just some of the craziness that we have seen with oil, with gold. And yeah, this AA is aluminum, and it hasn't really seen the massive sell-offs that those other ones have seen. But it still makes me a little bit cautious because it's in that basic materials sector. And even though they're not exactly related, there is some correlation between all those. TEVA, I really like this trade setup a lot. Good chance at you know, I'm going to be long on this one the next day or two. I didn't like it as much as CBS, and I don't like it as much as GLW. That's why I've got into those already. But I do like this one a lot. It's coming out of the base nicely. And it's above the 20-day moving average, which I think is very important for it. And it looks like it wants to get back up into the 60s. So, you know, keep an eye on that in the coming days. It's coming out of its bull flag nicely, which some of the others have not done, but Teva is the exception here. C. Beautiful breakout today. A number of people in the splash zone spotted this morning, and they're already in the trade. I've passed on it so far, but it's turned out to be a pretty darn good trade for those who have gotten into it. Basically, what you have here is you have a base that Citigroup is breaking out of. So I mean that's beautiful. Okay, it's breaking out of it. The ideal place to get in was like around 54.50. So anywhere between like 54.50 and 54.70, that's your key entry price there. I feel like if I get into it at this point, you know, I'm chasing the stock, so I'm not going to do it. But the stop losses are pretty good on it. You can do it with a little bit less than a 4% stop loss, so not a bad trade at all. EMC, similar to Citigroup here, you know, but in terms of what kind of setup it is. Get back to it. There we go. You got a little bit of a triangular pattern maybe per se on this one, but you know, if it gets back above like around 30.40 or so, that's where you want to get long on EMC. I don't think it's worth getting long on yet, but it could be in the coming days. IBM, this one's been a really weird stock, and it's weighed itself heavily down on the Dow Jones. I mean, it hasn't been friendly to the Dow at all, but if you look at this, I mean, it's putting together a nice base. You could say that's like a double bottom of sorts. Not your textbook kind, but you know, it doesn't have to be textbook for it to be a legitimate pattern that you can trade. But I could see where, you know, if it gets back above, let's say, like 163.71 or so, this thing could see a huge rally into this gap. So this is one I'm definitely watching in the days ahead, and one that I think could be a great trading opportunity. Finally, you got MOS, and you know, this is back into the basic materials. MOS has a tendency to do some really crazy price action. So while basic materials is really just, you know, acting bonkers in the last, you know, few weeks, and that on top of oil and everything, I'm not overly inclined to jump into MOS. But that, I mean, there is a valid trade setup here. There's some support right here that it's finding. So it bounces off of support in the 44.30s, and now it's at 45.80. No, I think you could definitely trade this one too. It's a little more than a 3% stop loss, but a very valid one at that. And that's going to be it for today. If you guys have any questions, I'm in the Splash Zone every day. There's a lot of new people that are signing up, and I'm grateful to have all of you in there. And we, you know, the trading journey is an experience that we take together. We learn together. We learn different strategies from one another. And I provide all my real-time trade alerts in the chat room. I also send them out to members via text, via email, and that's for international people as well. So if you want to try us out, it's a free 7-day trial, as always, and you can try it out. I am raising my rates on Friday, so if you're going to try it, you know, you can lock in your rate, you know, and get into that trial, you know, today or tomorrow, and you'll have that $59.95 rate permanently. So I'll never raise it. I'll never raise rates on existing members. I'm just not going to do that. So so yeah, definitely get into the Splash Zone today and join us and see for yourself if it's a place for you. Love to have you. I'm going to aim to do another video on Friday. So tomorrow's going to be the share planner reversal indicator that I publish weekly, and then Friday I'll do another video. All right. Well, you guys have a great day, and God bless.